Hello. As part of the X-Cred series, I'm here today with Gary Lowe, who's Head of Credit Insurance at Standard Chartered Bank. Gary, welcome.
Thank you very much for having me.
Thank you. Initial question, how has your use of credit insurance changed over the past year?
Well, it certainly grew in 2018. We put on 25% more term risk into the market than in previous years. So we put on just over $3 billion of notional risk. It's about a $6-7 billion book overall now. But it wasn't all about just volume for the sake of it. I think we saw a big diversification in our use of the product. So things like vanilla products, but what for the insurance market have been relatively new over the last couple of years, like revolving credit facilities, but also things like real estate. And we started looking at portfolios far more than we did in the past. Things like securitization, mezzanine tranches. So it was an exciting year. That all in addition to the kind of traditional sovereign and corporate and FI business, which still remains the biggest part of it.
You talked about some of those changes. Were any of those changes particularly surprising?
Well, look, I think since we started the desk, and I've been doing it since 2012, we've seen a steady evolution of appetite. I mean, I think if you look at the way the Lloyd's regulations changed, the way that the company markets grew, the way that some of these concepts I just outlined were impossible to consider for the insurance market 5 or 6 years ago are almost standard now. I think perhaps away from appetite and thinking about markets, it was perhaps surprising to see some insurers withdraw from the market completely at the same time as other insurers coming in with fresh capital. So I guess there must be some competing forces as to who's coming in and who's going out. For us, it's really about staying on top of the market and keeping those strong relationships that we've had with people who have supported us from the beginning and introducing ourselves to new participants in the market and asking them to support us, because we think we offer something interesting in terms of the risk profile that the bank's involved with across the globe.
A changing market. What are you most looking forward to in 2019?
Well, I mean, more of the same. I think we're going to be growing some of those more innovative products that I just mentioned. I know the first securitization happened within the last month or two. Whilst that was for residential mortgages in Europe, which is not particularly relevant to us, you can translate that technology into Asian project finance or Middle Eastern sovereign or a whole bunch of things and look at tranches. I think secondly, whilst the market has always been very good traditionally at sovereign risks, it's always been, traditionally at least, the kind of export finance, so tied to a very real trade of goods or building a railway or a hospital or a road or something. But actually, from our perspective, sovereign risk can be far simpler and pure than that. So we've been looking at, for example, repos and swaps and foreign currency derivatives with central banks. It's actually the same risk profile. We just call it something else. I think educating insurers and to be fair to the market, many people are already on board with what we're trying to say about this. But bringing those sorts of transactions to the market, it might be part of what's new in 2019.
And what do you think your biggest challenges will be in 2019?
I guess there are external and internal challenges around that. Without getting too much into politics, Brexit's obviously chiming a few doors from us here in central London. But I think that, from an insurance perspective, is really about things like which particular entity or security insurers are offering, and it's quite a dull, rather tedious kind of complication. But knowing whether it's an insurer's Luxembourg entity or a London entity is relevant to a bank, which needs to mark counterparty limits against them, and that kind of brings me into the internal challenge. We've built up a pretty significant book of business over the years. And I don't really think my job at the bank is just to pile that on endlessly, or we end up in a situation where we're running contingent concentration risk on insurers just as much as we've been de-risking concentration risk on the underlying obligors. So we're really looking to focus on where the value lies, and it's some of the products that I just mentioned. So not to concern anyone, I think we'll probably be growing again in 2019 as we did in 2018, but I'm very much focused on deploying the expertise that we have and the power of the market into areas where they create real value. And I think that's an opportunity for insurers as much as it is for us, because we'll be asking them to support us in areas like repos or real estate or securitization, or different types of sovereign business or non-correlated business that they're not necessarily seeing from others, in a way which creates value for us, but is also adding something to insurers' books. So I hope that what is a challenge, and I think that kind of whole stuff around limits may be a challenge, could potentially be an opportunity for us all.
Okay, very good. You mentioned Brexit there, and off camera we were talking about threats to free trade and to some extent sanctions.
Yeah.
How are you dealing with that?
Well, obviously it's a global bank with a widespread footprint. So when we see tariffs and trade wars between the US and China, it is very real to our global business, as it is to most global banks. But I think, as you rightly said, we were discussing earlier, I think when you look at Chinese GDP growth and the population and the strength of what's happening to domestic companies there, I'm pretty much an optimist when it comes to these sorts of macro factors. A lot of the issues that we see, whether it's Brexit or the Brazilian elections or the Congo elections that we had last week, are very real, but they're in many ways localized, and I'm fairly optimistic overall that we'll see trade bounce back, and we'll see economic growth continue. And whilst I don't want to dismiss any of those points because they're very real, and in many ways that's why banks and companies look at political risk insurance and credit risk insurance in the first place, is to manage and mitigate the very risks that we're discussing. Overall, in the aggregate, I think we'll be fine. I mean, one number that I use to illustrate this is quite easy to measure, which is we've spent over $200 million of premium into the insurance market, and we've collected a couple of tens of millions in premium. So if you look at it in the aggregate, the sorts of risks that are building up, whilst they materialize in isolated cases, something might happen in Sierra Leone, something might happen in Indonesia, in aggregate, it's a pretty robust and positive picture that I think we see.
And would you like to see changes to the insurance product itself? And if so, what changes would you like to see?
Yeah, I mean, people who know me in the market will know I quite often talk about the need for us to bring investors into insured assets. What I mean by that is the bank using its origination and structuring expertise to bring a loan or even a bond to a client. To use the credit insurance product to manage limits and to manage capital and all the things that we know we use it for. But then to be able to bring a funded investor, whether it's a regional bank without origination capabilities, or whether it's a non-bank financial institution with yield requirements, to participate in that blended risk. So yeah, we've seen the first ones happen in the last year or so, things like the AFIC aviation format, which we're behind and looking to grow. Things in the sovereign space with multilaterals, I think are particularly exciting. And I think to the extent that we can do more of that, will be a real positive for each party in the chain. And obviously insurers need to retain alignment of interest. They want to know who their relationships are with. They want to know who's there when things go wrong. We absolutely understand and respect all of that, and we don't wish to change any of that. We plan absolutely to bring all of those strengths to the transaction. But I think the ability to grow this business and this market, and indeed diversify the client base, isn't necessarily about pitching to corporate buyers of PRI. I think it's about doing what we do well already and bringing the serious power of capital markets into funding this risk profile. And that's something we're spending a lot of time and energy on, and I hope 2019 brings a little more success in that area.
Very good. Gary, what's next for you and for Standard Chartered?
Well, more of the same. I mean, I don't think we're finished doing what we're doing now. I think a lot of those product innovations that we discussed, I think general optimism about the footprint markets that Standard Chartered are in as an emerging market focused bank are still as relevant, just because we've clocked over to 2019 as they were in 2018. I hope to be continuing to be running and growing this book during the year. I'll be traveling quite a bit to some of the conferences and some of the markets, and seeing a lot of our market participants in person. I'm always surprised when one looks back over 12 months, quite what one has achieved and wasn't necessarily what one set out to do. So without wishing to dodge the question entirely, I think a lot of hard work, and hopefully we'll be looking back in 12 months at what we did in 2019, with a reasonable sense of satisfaction. Let's hope so.
Yep, let's hope so. Very good. Thank you very much.
Good. Thank you very much.